Welcome to the Deep Dive. Today, we're going to be looking at something you're probably already familiar with, asset price bubbles.
Mm-hmm.
But we're going a little deeper than usual. We're going to be exploring the very definition of these phenomena. You've shared a paper with us. What are asset price bubbles? A survey on definitions of financial bubbles. So I'm guessing you're interested in really understanding this complex subject.
Yes, this paper really gets at the heart of a problem, a critical issue that we often overlook when we talk about financial markets. There's no universally accepted definition for what a bubble actually is.
That's a really interesting point. We hear the term bubble all the time, when we're watching the financial news or reading analysis. But it seems like there's not actually a common understanding of what exactly defines a bubble.
Exactly. And this lack of a precise definition, it really changes how we can identify them, how we analyze them, and even how we respond to these things in the market.
Now, I think most of us, we kind of have an idea in our heads, like what a bubble looks like. You see prices increasing really fast. Maybe they're not really connected to any real value. And then suddenly, boom, there's a crash.
Yeah, that's it. That's that classic boom and bust. It's what we usually think of when we think of bubbles. And the paper actually has this graph, figure one. It's called exemplary paths. It shows this perception visually.
Yeah. That image is really, it's quite striking. But the paper says that if we only focus on price patterns, that might not be the whole story.
Exactly right. You have to consider the fundamentals, those underlying factors that actually make an asset worth something. And those fundamentals, well, they can change too. So just because prices are going up fast, it doesn't automatically mean it's a bubble.
So it sounds like we have to go deeper. We can't just look at the price chart. We have to think about the things that give an asset its real value.
That's exactly it. And that's where fundamental value comes in.
hmm
That idea is really central to a lot of the ways we define a bubble.
Okay, so the paper highlights this, the most common definition. A bubble happens when the price of something goes way higher than its fundamental value.
But then that leads to the next question, right? How do we actually figure out what that fundamental value is? And the paper goes into a lot of depth about that because there are a lot of different ways to define and calculate that number.
So even if we agree that a bubble is like a departure from that fundamental value, we still have to figure out how to define and calculate it in the first place.
Exactly. The paper looks at all sorts of different approaches, each with their pros and cons. One common approach is to look at the present value of the future cash flows.
So we try to predict how much money an asset will make in the future, like dividends from a stock or the rent from a property, and then we bring those future earnings back to today's value.
Exactly, you got it. And that means we have to estimate future cash flows and then use an appropriate discount rate that reflects, that money today is worth more than money tomorrow. The Gordon growth model. That's a simplified way to do this. It assumes that dividends will grow at a constant rate.
Right. So that Gordon growth model, it's like a classic tool when you're trying to figure out how much a dividend-paying stock is worth.
Mm.
But what about things that don't have those really clear, predictable cash flows like gold or art or even cryptocurrencies? How does that method work then?
That's where some other approaches come in. Some researchers say, look, let's look at historical data. Let's compare it to the actual discounted dividends or cash flows that the asset generated, like over a very long time period, like decades.
So instead of trying to predict what will happen in the future, we look at what actually happened in the past and use that to figure out the fundamental value.
Exactly. And this can be useful, especially if an asset doesn't have a lot of or any predictable future income. The downside is you need good historical data, which isn't always easy to find.
That makes sense.
Yeah.
Looking back at the data can help, but it's not a perfect system. And as you said before, fundamentals can change. So even if an asset did well in the past, it doesn't mean it will in the future.
Right. And for things that aren't just about financial returns, it's even more complicated.
Like with real estate, people get value from living in a house, not just the rent they could collect.
Precisely.
Hmm.
So with things like that, economists have to figure out how to account for those benefits, like use value or the opportunity costs, when they're trying to figure out the fundamental value. Like, think about a house. You could say that its fundamental value is what you'd have to pay to rent a similar house.
So even when there aren't direct cash flows, we can still sort of estimate a fundamental value based on like what benefits you get from the asset or what it would cost to get those benefits somewhere else.
Exactly. The hard part is making sure you can measure those non-monetary benefits in a way that makes sense and is consistent.
Right. So we have these calculations based on present value, But then there are other metrics too, like book value, resale value, and Tobin's Q.
Right. They give us more ways to think about what an asset is worth. Book value is basically a company's net worth, from their financial statements. It's assets minus liabilities. Resale or liquidation value is how much you could get for the asset if you had to sell it quickly. And Tobin's Q compares the market value of a company to how much it would cost to basically build a brand new version of that company.
So each one of these metrics gives us a slightly different way of looking at an asset's value. But it seems like none of them can really give us a definitive answer about fundamental value.
Right. And which approach you decide to use, that can really affect whether you think an asset is in a bubble or not.
So it seems like there are lots of ways to look at this, which really highlights how complex it is to define and identify asset price bubbles. We can't just look at a chart and see prices going up quickly and say, oh, that's a bubble.
Exactly. There's no one way to define fundamental value. And that makes it even harder to figure out when something is a bubble and how to react. And that brings us to a really important idea: heterogeneous fundamentals.
Heterogeneous fundamentals. Can you explain what that means?
Sure, it means that different people in the market might have completely different ideas about what an asset will be worth in the future. So even if they're using the same methods to figure out fundamental value, they might come up with completely different numbers.
So one trader might think, whoa, this is way overpriced, total bubble. But another trader, with different expectations, might think the price is totally reasonable.
That's exactly it. The paper mentions some work by Harrison and Krebs. They argue that the only way to say for sure that an asset is overvalued is if every trader thinks its price is higher than its fundamental value.
But that seems impossible, right? In the real world, it's so rare for everyone to agree on something like that.
It is. Almost never happens. Which brings us to a really big question. If fundamentals are subjective, like based on what each person believes, how can we ever say for sure that a price is a bubble?
That's a really deep question. It seems like the whole idea of a bubble gets kind of fuzzy when you realize that people have different ideas about what things are really worth.
That's a big challenge in trying to figure out bubbles. There's no single objective measure of fundamental value. So trying to figure out if something is a bubble, well, it becomes subjective too.
So if just looking at fundamental value isn't enough, are there other ways to define bubbles? Maybe ones that look at what prices are actually doing instead of trying to figure out the, intrinsic value.
Yeah, the paper talks about some alternative definitions. These definitions focus on patterns in how prices behave instead of trying to figure out fundamental value, which can be subjective.
Okay, that's interesting. Maybe by just looking at how prices are moving, we can understand bubbles better without having to get lost in those really complex calculations of fundamental value.
Right. These alternative definitions give us a different way of thinking about how to identify and understand asset price bubbles.
Now, this is where it gets really interesting. By shifting our focus from fundamental value, which is always up for debate, and looking at prices, real numbers, we might be able to unlock new ways of understanding these bubbles. So let's dive into those alternative definitions and see how they can help us understand these fascinating and, let's be honest, sometimes really confusing market events.
Okay, so let's dig into these alternative definitions, the ones that look at how prices are moving instead of that fundamental value idea.
One way to define a bubble is just to say it's a period where prices go up really fast, no matter what's causing it. This definition, it's often called a boom, and it's all about the price trend, not whether the fundamentals actually support it.
So anything that's going up in price a lot for a while could be a bubble, even if its fundamental value is also going up.
Exactly. That's the key here. We're not even talking about fundamental value. It's all about how much and how long the price is going up. It's a pretty simple approach, huh? Just look at the numbers. It might not be as, nuanced as looking at fundamentals, but it definitely makes it easier to spot potential bubbles.
Exactly. We're moving away from trying to figure out the true value and just looking at what's happening with the price.
Another way to define a bubble is to focus on a big, sharp drop in price. That's the defining characteristic. This is often called a crash. It's kind of like working backwards. You see a huge drop and then you say, okay, there must have been a bubble before that.
Yeah, you're right. This definition is all about saying, okay, this crash happened, so there must have been a bubble leading up to it.
So maybe it can't help us predict bubbles, but it can, help us understand what happened in the past. Maybe we can spot some patterns, see what led to the bubble and the crash.
Exactly. It's good for looking back and analyzing, trying to learn from what happened before.
Okay. And the third way to define a bubble based on price is all about how volatile it is. Like, if the price swings up and down a lot, especially when the fundamentals haven't really changed much, that could be a sign of a bubble.
Right. This definition really highlights how speculation and, people's feelings can make prices jump around. If the price is bouncing all over the place, but the underlying value hasn't changed, that's probably a sign that, emotions are driving the market, which is, often what happens in a bubble.
So the boom definition is all about the price going up. The crash definition is about it going down. And this volatility one, it's about the price just being really unpredictable.
That's a good way to put it. They all look at bubbles from a different angle, and they can all be helpful along with looking at fundamentals.
So we have all these different ways to define a bubble based on fundamentals and on price. But how do people actually use these definitions, like in the real world? How do researchers and actual investors use these ideas to study bubbles, to find them, and maybe even to do something about them?
That's a good question. These definitions are used all over the place, like in research and in the actual markets. They change how we think about and deal with the markets.
One place where these definitions are really important is in something called bubble tests. These are like statistical tools that try to find bubbles in the data.
Right. These tests look for specific signals in the data, like in the prices that could mean there's a bubble. They use both fundamental and price-based definitions, all sorts of different statistical methods to analyze how prices are moving, how volatile they are, and how far off they are from their fundamental value.
Like, there's this test called the Augmented Dickey-Fuller test, or ADF test.
Mm.
It looks at whether prices, or like the price-to-dividend ratio, are going up in a way that seems unsustainable. That could be a sign of a bubble.
Exactly. The ADF test is based on the idea that a bubble is a deviation from fundamental value. It's looking for those price trends that can't be explained by what's really going on with the economy or the company.
Then there's another test called the Log Periodic Power Law test, or LPPL. It looks for specific patterns in how fast prices are going up. Patterns that have been associated with bubbles in the past.
Yeah, the LPPL test comes from the fact that a lot of bubbles have shown this specific pattern of faster and faster price increases leading up to a crash. So this test tries to find that pattern in current prices using mathematical models to fit the data and figure out how likely it is that there's a bubble.
This is interesting. The LPPL test, it's based on the idea of fundamental value.
Yeah.
But when you actually use it, you don't need fundamental data. It's all about looking for those specific patterns in the price.
That's a good point. A lot of these bubble tests start with the idea of fundamental value, but when you're actually using them, you end up just looking at the price.
So we have statistical tests, but then there are these more complicated models too, like heterogeneous agent models or HAMs.
Yeah. HAMs are basically simulations of financial markets. They try to include all sorts of different kinds of traders, each with their own ideas, strategies, and ways of reacting to what's happening in the market.
So in some of these HAMs, the fundamental value of an asset is already decided. It's either a fixed number or, it changes in a predictable way. And then the researchers watch how the different types of traders, like the ones who are really into fundamental analysis versus the ones who just follow trends, how they interact and how that affects prices.
Exactly. By including all these different types of traders, HAMs can create these really realistic market simulations. And that includes bubbles forming and bursting.
So these models are a good way to see how different trading strategies and, just human psychology can lead to bubbles, even when everyone knows the fundamental value.
That's it. HAMs show us that behavioral factors and the complexity of the market can cause prices to move away from their fundamental value.
Another really interesting area of research is experimental economics.
Right. Experimental economics is all about creating these controlled environments, like fake markets. Researchers can watch how people actually behave in these markets under different conditions.
So in these experiments, they often give people assets with a known fundamental value, and then they let them trade these assets. The researchers can then see if bubbles form, how they develop, and what might be causing them.
Exactly. It's a unique way to study bubbles because everything is controlled. You can really isolate how people act and what their psychology is without all the noise of the real-world markets.
These experiments have shown some pretty interesting stuff about how people make decisions when it comes to money, like how we can be biased, follow the crowd, and get carried away with speculation.
Definitely. They've shown that bubbles can form even when everyone knows the fundamental value, so psychology is a big part of it.
Okay, let's move from these controlled experiments to the real world and talk about housing.
Yeah.
How do these bubble definitions work in the housing market?
Housing markets are a whole different beast when it comes to bubbles. Like we said before, trying to figure out the fundamental value of a house, it's really tricky. There are so many different kinds of properties, and you have to consider things like, how much people value living in a certain area and how hard it is to buy and sell houses.
So the traditional ways of defining bubbles, comparing prices to other prices or to easily calculated fundamental values, well, they don't really work so well with housing.
That's right. It's just more complicated.
But even though it's hard, economists still have ways to figure out if there's a bubble in the housing market. One common way is to look at the price-to-rent ratio.
Yeah, that ratio compares how much it costs to buy a house to how much it would cost to rent a similar house. It helps you see if house prices are like out of whack with what people are actually paying in rent.
Right. If that ratio is really high, it could mean that house prices are inflated compared to the rental income they can generate,
Right.
which could be a sign of a bubble. But like we talked about before, when house prices go up, people often start expecting rents to go up too. So that could hide a bubble.
Definitely. You have to be careful with that ratio. You have to think about all the factors that could be pushing those rents up.
So it's a useful tool, but you have to use it carefully. You can't just look at it in isolation.
Exactly. You have to look at the bigger picture. And that's where these econometric models come in. They use all sorts of data like income levels, interest rates, population growth, and how much construction is happening.
So by looking at all those things, these models try to see if house prices are moving away from what should be driving them, based on those economic factors. That could be a sign of a bubble.
Exactly. These econometric models take a much broader view. They try to include everything that could be affecting house prices.
And researchers also use those price-based tests we talked about, like ADF and LPPL, to look for patterns in how house prices are moving.
Right. They can help spot those statistically significant trends that might mean there's a bubble.
So whether we're talking about stocks, bonds, oil, gold, or houses, researchers and investors are using lots of different tools and methods to try to understand these bubbles. They're using all the definitions we've talked about to study, identify, and figure out these really interesting and important events in the market.
Exactly. It's a complex field. We use ideas and methods from economics, finance, math, psychology, even history to try to get a handle on these bubbles. They can be really hard to predict, and they always have the potential to cause chaos in the markets.
So it's been really helpful to explore all these different ways of defining a bubble. It shows that there's more to it than just seeing prices going up quickly. We have to think about both fundamentals and how prices are moving to really get the whole picture.
That's right. It's a nuanced issue. There's still a lot of debate about what a bubble really is, but by understanding all these different approaches and what their limitations are, we can get a better, more informed view of these events.
Wow. This whole discussion about how to define a bubble has been really eye-opening. It's clear that we can't just look at prices and, immediately say, oh, that's a bubble. We have to think about all these other things, too, the fundamentals and how prices are actually moving.
Yeah, you're right. To figure out if there's really an asset price bubble, you have to take a multifaceted approach. You have to use all sorts of tools and look at it from different perspectives.
So, we've been talking about this from a more academic perspective. But a lot of people are probably wondering, like, how do I avoid getting caught in a bubble? Or, at least how do I minimize the damage if one bursts?
That's the million-dollar question, right? That's what everyone wants to know. And unfortunately, there's no magic formula. You can't predict these things perfectly. But understanding how bubbles work can help us make better decisions.
Okay, so what are, like, the key takeaways from our deep dive? What can people actually use to help them navigate these, potentially risky situations?
Well, the first thing is be skeptical. Don't just buy into the hype. When everyone's excited about a market and prices are shooting up, that's when you have to be the most careful.
Yeah, it's easy to get caught up in the excitement. You see everyone making money. You don't want to miss out. But that's exactly when you need to take a step back and really think critically.
Right. You have to remember, crowd psychology is a real thing. People can get, irrationally exuberant, and that drives prices up way beyond what's reasonable.
So don't just give in to the fear of missing out. You have to make decisions based on a, realistic assessment of the value and how the market is behaving.
Exactly. All the definitions we've been talking about, they give you a framework for looking at the market and spotting those potential red flags.
Like understanding that present value calculation and its limitations can help you see if the price is justified, based on what you can reasonably expect to earn from the asset in the future.
Yeah, and you can also look at those other metrics like book value, resale value, Tobin's Q. They give you more information about what the asset is worth. And that can help you avoid, paying too much for something that's just caught up in the hype.
And remembering that some markets, like housing, can be kind of, self-fulfilling. That can keep you from, like, convincing yourself that a price is okay just because everyone thinks it's going to keep going up.
Definitely. The housing market's got all these complexities, and psychological factors play a huge role. You see this all the time. Prices go up, people expect them to keep going up, and that creates more demand, which pushes prices up even more. It can be a dangerous cycle.
So you can't just look at the price trend. You have to look at, the bigger economic picture. Can people afford these prices? What are interest rates doing? What's happening with population growth? What about supply and demand?
Exactly. You got to look at both the micro and the macro, You have to understand the specific asset and the overall economy to figure out if what's happening is sustainable.
Okay, so we talked about fundamentals, but those price-based definitions, they're important too, right? Like seeing prices going up faster and faster, seeing that volatility, noticing when prices are getting way out of line with fundamental value, those can be warning signs, right?
Absolutely. They tell you that maybe emotions and speculation are taking over and prices aren't really reflecting the true value anymore.
But it's important to remember, there's no one perfect indicator. There's no guarantee. Figuring out if something's a bubble is always going to be tricky, and people will disagree.
That's just the nature of it. It's an area where there's still a lot of research being done. We're always learning new things, coming up with new ways to analyze data. We may never be able to predict bubbles perfectly, but we can keep getting better at understanding the risks.
So even though we can't avoid bubbles completely, if we're informed and if we're disciplined, we can at least reduce our risk.
For sure. If you do your research, understand how psychology affects the markets, and, always stay a little bit skeptical, you'll be in a much better position to handle whatever the market throws at you.
This deep dive has been fantastic. We've learned so much. We're walking away with, a much clearer understanding of these bubbles. We can look at them with a more sophisticated, more critical eye.
Knowledge is power, especially when it comes to money. Keep learning, keep questioning assumptions, stay informed, and you'll be able to make better decisions and weather those market storms because they will come.
This has been a great discussion. It's a topic that can be really confusing and honestly, sometimes pretty scary. But you've really helped to clarify things. Thank you so much for sharing your knowledge and insights with us.
It was my pleasure. I hope this has helped people understand these bubbles better and given them some practical advice on how to handle themselves in the markets.
And all our listeners out there, keep learning about this stuff. Dig deeper, read more, pay attention to what's going on in the markets. And most importantly, think for yourself. Don't just follow the crowd. The financial world is full of opportunities, but there are also risks. If you're smart and careful, you can take advantage of those opportunities and avoid the worst of the pitfalls.
Well said. On that note, I think we've covered a lot of ground today. We've really taken a deep dive into asset price bubbles.
That's a wrap on this episode of The Deep Dive. We'll be back next time with another fascinating look into your world. See you then.